Well, hello, traders and investors. My name is Roger Scott. I'm the head trader for WealthPress. Today is June 5th, and it's a Friday. And my question is, where did the week go? Where did the month go? And where did the year go? I'm still thinking January, February, The year is just flying by. Honestly, this year, I don't know where it's going. But today's Friday. We got jobless data. We got employment data, big data. But let me start with the global events. Then I want to talk a little bit about the bond market. Then I want to talk about the indices, and then I want to talk about the news. So we got a lot to talk about, but I want to tell you what the biggest surprise for me this week is, and I think it'll put you in line with me in terms of what I'm seeing with the market. So let's start with the news. Global markets rose Friday. Wall Street futures are awaiting the U.S. job reports for May, which I'm going to get into right now. I wanted to wait for a few minutes till it came out before giving this, so we'll be able to go through it in today's session. So it'll be coming in just a few minutes. Economists expect the Labor Department monthly job report for May to show employers slashed 8.5 million jobs last month, down from 20.5 million in April. So right there, you could see that the expectation is right at 8.5 million. It doesn't matter if 8.5 million is good or bad. It's what the expectation is. So if the report comes out worse than that, it's going to be a negative report. But if it comes out a hair above that, it's going to be a positive report. I want you to understand, it's not based on the actual number. It's based on the expectations. The expectations are already priced into the market. Now, that would push unemployment rate to nearly 20% from about 15%. And I think that's what we were expecting. A truth to be told, I think a few months back, we were expecting worst case scenario of about 20% unemployment rate. Now, that would raise the total losses during the coronavirus pandemic nearly 3 months ago to about 30 million. More than triple the number of jobs lost during the 2008-2009 Great Recession. Again, 30 million. 30 million. Now, regional airlines were strong gainers after American Airlines surged 41% Thursday, the biggest gain in the S&P. It announced plans to fly 55% of its normal schedule next month, up from only 20% in April. That's huge. That is huge. Many professional investors, including me, believe the nearly 40% climb for the rally since March is overdone and is set to pull back. And actually, that's one of the things I'm going to talk about in a minute. The yield on the 10-year Treasury rose from 0.87 to 0.81 late Thursday after rising decisively during the day. It tends to move investors' expectations for inflation and economic strength, and was one of the first indications that gave us a good indication of coronavirus being here. It was spiking like crazy. Several news agencies reported on Friday that OPEC nations and allies like Russia would hold a teleconference on Saturday. Yeah, good luck with that. The meeting comes as Saudi Arabia, Russia appears to want ongoing oil cuts to continue to help boost the market. They've got to, otherwise things are just going to be really, really bad. So now let's see if we have the expectations on the jobless claims yet. Let's take a quick look. Ooh, wow. Look at that. Actual number, 2.5 million. And the unemployment rate at 13%. So as you could see, the unemployment percentage is better than the expectations, and the consensus is actually substantially better as well. This is good. This is actually kind of positive. This is better than expected. That's kind of shocking. We're expecting negative 11 million to negative 3.5 million, and we got a positive 2.5 million. Very interesting. Unemployment also on the lower end. This is positive. This is a big surprise, actually. Wow, that's impressive. But I want to show you something interesting. Look at the bond market. You notice the bond market started cooling off? Well, here's the interesting thing. If you look at the NASDAQ 100, I want to show you this. Notice the NASDAQ 100 has been really, really strong, right? But the S&P 500 has been just barely breaking the 200-day moving average. But now it looks like it's ready to move higher. The bond market was waiting for the S&P, for the broad market to move higher or move above the 200-day moving average. And once it did, the bond market started cooling off and thinking, hey, the worst is behind us. But notice, bond market only started falling. Look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 2 weeks, right? And then look at how long the S&P has been above the 200-day moving average. which is right here, this line. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It's not a coincidence. So the bond market was kind of holding on, near all-time highs or close to all-time highs, and thinking that if the S&P 500 moves lower, we're going to have another spike. But that's not happening, and that's very, very positive. And this employment report is much better than expected because it looks like we actually gained employment, and unemployment rate in a percentage-wise is much, much better than expected. And I'm already seeing the futures rally ahead of the day. Now, notice something interesting. If you look at this at the QQQ, let me go back. That's the Nasdaq 100. The Nasdaq 100 is only up 0.11, while the S&P is up 0.73. Now, as of this, only started about a week, 2 weeks ago. This was not up to about a week and a half, 2 weeks ago. The Nasdaq kept leading, and the bond market was waiting. It was waiting to see what was going to happen. But the worst is behind us. Now, I have got one more concern. I've got one more concern here, and I want to talk to you about that. That's very, very important. If we look at momentum levels, I'm glad that the S&P is starting to outperform. But if you look at the S&P, first of all, if you look at the overall market, look at the number of stocks trading above the 50-day moving average, and look at the number of stocks trading above the 200-day moving average. So while the S&P is giving us a bullish indication, the overall market is still sort of bearish. But the short-term trend is extremely bullish. So I believe, and if you look at the S&P, it even looks worse. If you look at the S&P, you'll see here 95% of stocks above the 50-day line, but only 48% of stocks above the 200-day line. And if you look at this chart here, and I've been paying attention to this, notice this level is the highest level we've seen. And we are bouncing off the weakest level we've seen in 20 years. Now we're at the highest level we've seen in 20 years. Percentage of stocks on a monthly basis is really high. So I'm expecting the market to curl lower. Now that's going to take the S&P and the Nasdaq down with it. But based on what I'm seeing, the odds are we could still hang out around these levels for some time, maybe another week and a half. But then I believe the market's going to start sagging. Now, I don't think the market's going to fall apart, but I do believe if we look at the SPY, let's look at the futures contract. I believe there's a really good chance the market's going to pull up a little higher and then come back and hit the 200-day moving average, at least based on the momentum levels that I'm seeing. I don't think it's going to be possible for the market to go a lot higher at this point, especially with the Nasdaq starting to weaken. And here's the biggest part, and this is what I wanted to show you. If you look at my averages, look, technology and consumer discretionary is leading, right? And material is now following, not healthcare. So there's some fragmentation here because healthcare should be getting a lot more upside than material right now. But if you look on a 1 month basis, this is 30-day basis. Before we were looking at the average. This is the average, but this is the 30-day basis. If you look on a 30-day basis, look at the stocks that are leading now. Energy, industrial, material, financial, all the stocks that over the long term are lagging behind. Notice that? So there's a good chance, and this is why we're seeing upside in the S&P. Technology was really, really strong because everybody was thinking stay at home, but now people are starting to look out, and stay-at-home stocks are starting to soften up, and momentum stocks, growth stocks, material, financial, industrial stocks, they are starting to rally, and I think we're going to see that for the next few weeks till the momentum levels catch up with us. And I think that's going to happen about a week, maybe a week and a half from now. So here's what I'm expecting. Expect more strength from the S&P versus the Nasdaq. Expect more weakness out of the bond market, at least for another week, till the S&P starts moving down. The S&P pull down, when this occurs, when the momentum levels break, will take the Nasdaq down with us. But the Nasdaq will more than likely stay above the 200-day moving average because it never broke the 200-day moving average, where the S&P, the odds are the S&P will break or hit or stay near the 200-day moving average because these momentum levels, these medium or short-term momentum levels, they are here to stay for at least another week or two. So don't expect more upside or a lot more upside from the S&P till momentum levels cool off. All right, very, very important. But I got to say, this employment report is a huge, huge surprise this week because look, we were expecting negative 3.5 million, negative 11 million. We got positive 2.5 million. Unemployment levels, we were expecting 17.5%, 20%. We got 13.3%. And that's why the S&P is starting to make a comeback. And that's why these sectors, energy, industrial, material, financial, are seeing upside right now. But again, momentum levels, these momentum levels, fundamentally, I like what I'm seeing. Technically, I like what I'm seeing. But these momentum levels have me worried. And I'm telling you right now, as I was telling you right here, this caught up to us, and this is going to catch up to us. Highest momentum levels in 20 years. Don't think this is not going to bite us in the butt. It will. But again, a little more upside in the broad market, a little lower volatility, a little more cool off in tech, and then momentum levels will hit us. We'll see more upside in bonds, and we'll see a pullback in the stock market. Another week, maybe another 2 weeks, and we're going to start seeing a little more turbulence in the road. Expect that. But I'm really surprised by this employment data. Things are moving in the right direction. Now, folks, there's a reason why most new traders fail. It's really simple. The truth is that majority of popular indicators or trading strategies that novice traders use simply don't work. They just don't. It's that simple. They were never tested, designed, or traded originally with stocks. Take a look when your favorite indicator was invented and tell me if swing trading was popular back then. Probably not. Wall Street even has a term for those strategies, dumb money. And they actively profit from betting against those traders. That's right. We do it with my momentum indicators, my volatility indicators. Those are not indicators that beginners use. And it's fairly predictable, which is how I was able to turn the tables on big institutional traders. And I do it consistently over and over again. Now, we're taking advantage of their moves using a relatively unknown indicator that has us seeing up to 479% gains in just a week. Can you imagine making 479% gain in a week? That's what I'm going to show you right now. Click the link below or the button at the end of this video. Don't miss out. 479% in a week. Stop following dumb money and start following the smart money. Do it now. Follow the link below or the button at the end of this video. Don't miss out. I hope you guys have a great weekend, and I'll talk to you soon. Bye.